Let's do it, folks. One and all, happy Friday. Good morning. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. Today is Friday, the 3rd of February, otherwise known as Jobs Friday. Happy Jobs Friday, except to all of you who did not think the numbers would be as scorching hot as they are. I'm your host, JD Durkin, here on the floor. Stocks are trading down, but maybe not really as down in the red as people had thought. This as investors continue to react to a ton of tech earnings and a much hotter than expected January jobs number. Emphasis on the word much. On the show this morning, let's talk about what's on tap. We will talk jobs as the economy adds 517,000 jobs for the month of January. That's not a typo, nor did I misspeak based on what's written in the prompter. The number really was 517. Plus, we'll be breaking down results from Apple, Amazon, and Alphabet as major tech earnings wrap up. And finally, Tesla's price cuts in China are starting to pay off. We will tell you what this means for the company. For more on those stories and so much more, we now bring in Mr. Martin Baccardax. Martin is our senior editor and our chief markets correspondent. Martin, how are we feeling?
Confused, to be perfectly honest, JD. Completely confused,
flummoxed
by
about your confusion.
That January jobs report just, I think, threw everyone for a loop. I mean, there's all sorts of statistical anomalies in there. The analysts have pointed them out. There's the sort of weather disruptions, some of the measurements, some of the components with respect to the change over December to January, and all the rest of it. But even with the breadth of forecasting for the month of January, and it was very wide, nobody had a figure that was even close to the 517 that we arrived with this morning at 8:30 a.m. Eastern Time. That just caught everyone on the back foot. And a large part of the growth was in the private sector. The private sector hiring, JD, was about 443,000. That's the strongest it's been in about 6 months. A decent component in government hiring, which is typical for the beginning of the year, gave the number a bit of a boost as well. But this is just solid across the board. The wage gains weren't particularly fast. They were essentially the same pace that we saw in December, and certainly markedly slower than we saw in November. And that does suggest there might be some revisions along the way. But nonetheless, the annual rate on a 3-month basis is very close to 5%. I think it's around 4.8%. So the Fed is going to be focused on that for certain. But nonetheless, the mystery of the job market, and I've written about this over the past couple of weeks, it sort of continues to puzzle those who watch it very, very closely. And I don't know that anyone has a correct answer to pierce through what it is that we're seeing. We had data yesterday, JD, from the Challenger Gray Christmas report, which basically categorizes layoffs across the economy. That number was the highest it's been since 2009. We're hearing about cost cuts all across the spectrum, from industrial companies to tech and everyone in between. And yet we see this titanic gain in private payrolls and indeed in overall payrolls for the month of January. So it remains a mystery. And the stock market reaction, as you can see, is a bit indecisive alongside it. More decisive than bonds, stocks are still picking their way through it.
I'm truly at a loss for words in terms of which component about this to look at first. But I guess unemployment's also interesting here. This is the lowest we've seen since 1969, 3.4%. What do you make of that figure? And then I'll ask you a few more Fed-specific questions in a moment.
Yeah, I mean, I think it's always good to look at the number, JD, but it's worth remembering that while mainstream media tends to look at this figure and to cotton onto it in a very significant way, you have to know that this number is calculated by the number of people who are actively in the job market searching for employment. So it may not represent exactly what we understand to be the headline jobless rate. The 3.4% is the lowest since 1969. Unambiguously good news, but is it a pure representation? Perhaps not. What we really have to look at is sort of labor force participation and whether or not people are moving into private or beg your pardon, into sort of independent employment, and to what degree the changing nature of work from home is sort of affecting that number. So while it is very good, it may not be the purest representation of the jobless situation.
And talk to us a bit more about the bond market reaction specifically, and any surprises for you there in terms of what we've seen just the last 2 hours.
huge acceleration in Treasury bond yields, JD. Essentially, what we saw after Wednesday, when Fed Chairman Jerome Powell spoke to reporters in Washington, he talked about disinflation and how some of those sectors in the U.S. economy were beginning to show signs of deflation and disinflation. And markets read that as suggesting that he was getting more comfortable with the broader inflation picture. The numbers that we have in the job market this morning, again, with reasonably solid, not spectacular wage growth, have sort of changed the game a little bit. So we've jumped significantly higher on 2-year Treasury note yields and indeed on 10-year Treasury bond yields. So investors are now starting to buy in to what Powell has been saying for a number of weeks and indeed a number of months now. They're going to get to 5% on the Fed funds rate, probably above it, and stay there until the end of the year. Now, prior to this morning's job numbers, JD, you had about a 50-50 split on whether or not the Fed was going to do 2 more rate hikes. They were almost certain to get 1 more in March, but they were split on whether they were going to get that second one in May, and that would take the Fed funds rate to the 5% level. Bets are now accelerating well into the 60% range for that second rate hike in May, and that does tell me now that markets are seeing underlying strength in the U.S. economy that they heretofore weren't prepared for, the job market being one of them, the services sector growth that we got this morning through the PMI data for the most important sector, which drives about 2/3 of economic growth. That number came in at 55.2 for the month of January. Anything over 50 represents growth, and the December figure was about 49.8. So that's a scorching read. It comes with a lower prices paid component and a really big jump in new orders. So it seems to me, JD, that the markets are now maybe coming to terms with the fact that the Fed can engineer that soft landing. It just may take slightly higher rates to get there. But if that's what it takes and the economic growth follows through with slower inflation, everyone will ultimately be happy. And that's, I think, what the Fed would like to see. And it's starting to get some very, if we would say, reluctant cooperation from the bond markets.
So what are you thinking if you're Jay Powell right now, I wonder?
Stay the course, I think, JD, to be perfectly honest. I think he had, I would say he was unfairly criticized last year for his talk about transitory inflation. I mean, ultimately, let's be honest. I'm going to steal a phrase from the late, great baseball announcer whose name is now completely lifted out of my head, Vin Scully. Vin Scully was describing the starting lineup for a particular Dodgers game one day, and he said that one player's status was day to day. And then he paused and he says, aren't we all? And he's absolutely right. I mean, every piece of economic data is transitory. Inflation is a rate, not a level. And therefore, by definition, it's going to be changing all the time. So he wasn't wrong to say that inflation is transitory because it speeds up and slows down on a monthly and annualized basis almost consistently. What people were upset about was the idea that their interpretation of transitory meant that inflation was going to slow in 2022. Now, clearly it did not, at least not to the pace that many people would have been happy with. But I think now Chairman Powell is sort of vindicated, at least in his second approach to inflation, which is that it's stickier than we thought, wage growth is a principal driver, and the economy can withstand the rate hikes that he has put in place. And all of that appears to be true, JD. We had stronger than expected fourth quarter GDP. The economy is running along at a nice pace heading into the start of the year. Inflation is slowing modestly, but not significantly, which validates Powell's stance. And I think now he is probably going to find a little bit of vindication in all of it by saying, if the market's buying into my 2 more rate hike theory and we can get economic growth off the back of it, it'll be job well done.
I'm also following comments right now. President Biden is, of course, emphasizing and underscoring the fact that the U.S. economy is strong. I think this is a pretty good, I mean, in terms of political messaging, it's a layup. But according to reports, there, of course, had been some hope or expectation internally from the White House. Not that they would say any of this on the record, that they had hoped this number was actually quite a bit cooler. But here's the president today, gives him an opportunity to talk about it. I do want to ask you about wages there. Wages up 4.4% year over year compared to estimates of 4.3. What does that mean? And what stands out to you there on that figure?
Not too much, JD, to be perfectly honest. I think the month-on-month number is probably the most significant. That was up 0.3% compared to December. December was up 0.3% compared to November. So we are seeing a relatively flat line in terms of wage advance. And as a result, I don't think anybody's going to be terribly spooked by the idea that we have these kind of wage growth numbers. I mean, when you put it into the context of 500,000 jobs added, 4.4%, I think most of us would have taken that had we been given the option prior to the 8:30 release. So a really good number with only modest wage rises. That really only gives sort of further coal for the furnace, if you will, with regards to bets on a soft landing.
So speaking of the Fed, what happens at the next meeting? You say stay the course, and that's what Mr. Powell says all the time, right? We'll stay the course until the job is done. That's his favorite refrain. But any reason to think we begin to move off of conversations of 25 basis points, given everything we've learned in the last really 18 hours?
Yeah, I don't think there's any legitimate discussion with respect to anything other than a 25 basis point rate hike for the March meeting, and indeed another 25 for the meeting in May. There's a lot of data, of course, to plow through between now and then, but absent any really significant downturn in inflation dynamics. And from what we can see from the economic data today, that doesn't seem to be on the table. Then I should imagine it will be much more of a stay the course kind of element. Now, what will be important for the March meeting, JD, is that we will get fresh economic projections from the Open Markets Committee, and as a result, we'll understand a little bit more how they are seeing things develop into the back half of the year. That might elicit some conversation. But again, unless there's a really significant change in the inflation trajectory, it's downward sloping now, but slowing ever so slightly. I don't imagine we'll get big changes in messaging or expectation. And we're on a slightly more straight line path to that 5% plus Fed funds rate.
Earlier this morning, for our premium members as part of the AAP portfolio, I was speaking with Sarge Guilfoyle, and we talked about the importance of the CPI figure, which is due out on February 14th. How important will that be to you, Martin, in terms of tracking, trying to get some sense on where the puck is going with all this? That's a pretty important one, isn't it?
I think it is. I think it's more important for the market than it is to the Fed, to be perfectly honest with you. I think they like to focus on the PCE inflation data rather than the headline CPI. But the market is undoubtedly focused on CPI for its day-to-day movement. So I think that will be absolutely important. What we are seeing, again, is that downward flow in data from the inflationary point of view, but the downward changes are less significant than they were in the latter part of last year. So to that degree, I think the January reading will be important, because if it accelerates heading downwards, that's a great thing. If we only kind of meet expectations, investors might get a little squirrelier with regards to their projections about where inflation is headed. I still think it is heading closer to the 2% target by the end of this year, but it may be delayed a little bit as a result of the strength that we're seeing in the economy.
Martin, for anyone who has sat there and wondered, I remember all these recession headlines. Wasn't that long ago. What is the state of the R word right now?
It's on nobody's mind at the moment. I mean, it's absolutely incredible. I think that PMI data for the month of January that came out this morning is getting a little bit underplayed, because it's a good representation of economic activity in the most important driver of growth, and that's the services sector. And as mentioned, that represents about 2/3 of the GDP advance. And that number comes in at 55.2. Anything over the 50 mark indicates growth. So this is well above trend growth. And if it were to continue into February and March, then we're looking at a very strong first quarter gain. Of course, there's a lot to play for, but nonetheless, the momentum is very, very strong indeed. The jobs number has caught everyone by surprise and maybe represents underlying strength that we didn't fully appreciate. Prices paid for companies that are in the services sector are starting to drop, and new orders are starting to come in. So yes, I think the recession talk is well into the rearview mirror, absent again some sort of exogenous shock that we can't predict at the moment. And that might be probably a significant change with regards to where people see the S&P 500 at the end of the year as well.
Before we pivot to earnings, because there's also lots to talk about. You may have heard from just the last couple of days and really yesterday after the bell. You and I could do an entire hour-long show just on the names after the bell yesterday, probably a 3-hour special. But before we get there, I do, as I like to do from time to time, want to give you the opportunity to address anything else in terms of bringing a little bit of much-needed context and perspective to this scorching hot number we got at 8:30 this morning from the Bureau of Labor Statistics.
I really think it's going to take a bit of time to pick through, JD, and I do wonder whether or not investors are going to accept that headline reading once some of the research comes up underneath and starts to poke holes in the BLS methodology. That's just my opinion. I can't say it for sure. But from a technical perspective, JD, markets are at an interesting inflection right now. Technical analysts describe a condition called a golden cross, which is essentially when the 50-day moving average and the 200-day moving average for the S&P 500 converge together. That's typically a sign that stocks are ready for another leg higher, and a sustained one at that. Now, that golden cross, of course, comes at a time when we're seeing, of course, these weaker than expected tech earnings, and indeed a weaker than expected fourth quarter earnings season writ large. But maybe that suggests that investors are seeing the value proposition in beaten down stocks. They like the data that they're getting on the economic side, and they're starting to pile in because, of course, by the time most of us understand where the stock market momentum is headed, it's already too late to catch that wave. The golden cross movement might be an opportunity for investors to catch it at just the right time.
All right, let's talk earnings. Got to start Amazon here. Shares were down in pre-market 4%. They're currently down 4.7%. I actually listened into the investor call, and first of all, I mean, we don't really hear from the CEO very often. Never really heard from Bezos on these things. We did hear from Andy Jassy, and he was, first of all, I thought that was noteworthy in and of itself. He came on the call and said, I'll be here from time to time, maybe not every earnings call, but it was kind of interesting to hear some of the banks ask him questions directly. But what do we learn from the e-commerce giant overall? I know there's a lot of specific concern for AWS forecasts, right?
Yeah, the Amazon Web Services forecast wasn't particularly great. I think actually investors are probably focused more on the broader revenue projection for the 3 months ending in March, because that's going to decelerate from the December levels. It's expected to some degree because, of course, Amazon benefits from holiday spending in a way that it doesn't in the first quarter. But nonetheless, the 121 billion to 126 billion range was south of the street forecast and caught investors a little bit by surprise. Amazon Web Services growth rate is absolutely going to slow as well. But I think that was for the large part understood given what we had heard from the chip makers, what we had heard from Microsoft, and a couple of other companies in the cloud space. So I don't know that that caught investors in a materially different position, but I think that overall revenue situation and the fact that the cost base is still relatively high and as a result is going to induce significant accounting charges to the quarter itself is a big component for the stock movement this morning.
Absolutely. Anything else there on Amazon? Just taking a look through here, some of the numbers. Obviously, it was a fourth quarter beat on revenue, which is more than you could say for a lot of these other companies that we're about to talk about. But it really seems to be that forward-looking guidance that seems to be concerned. Do you have any reason to think that the things may settle down here a little bit? There's a bit of a knee-jerk reaction after hours and into today, but at some point that things will kind of settle for Amazon investors?
I've always found Amazon a difficult stock to understand, I think for some of the reasons you just articulated, JD. For the most part, the bulk of its revenues come from the online retailing space, and that's a narrow margin business, and it tends to be cyclical. So you can understand why investors would be a bit concerned about a softer revenue projection when the cost base is high, because that, of course, is going to compress margins. Now, the revenue beat, at least from my understanding of it, was powered in part by the Amazon Web Services number, but that missed street forecasts as well. So I think absent any particular number from the earnings release last night or the forecast afterwards that really stood out in a positive way, investors simply just looked at the whole of the picture, see it as muted, and are selling down the stock at the same time. But I do take your point. I think once people plow through the numbers and sort of begin to cherry pick some positivity, and I'm certain that it is buried in there for a company of that scale, it will begin to come back. But again, just to my earlier point, Amazon is a stock that I do find trickier to sort of focus on than some of the others.
Yeah, it is down about 4 handles and change. It's trading right now at 107, almost 108. We'll certainly follow that number and see if there is that little bit of a bounce back as the Friday session continues to roll along. Meanwhile, let me ask you about Google parent Alphabet, also reporting yesterday. Different story than Amazon, right? Alphabet here missing on both top and bottom. What are some of the major headwinds you think weighing in on that company's last? I'm looking at the numbers here up on the screen. Did I get that right? Actual, expected, yes, on top and bottom. What are some of the major headlines weighing in there for the last quarter for Google?
Yeah, I mean, it's an ad sales story for Google for the most part. And we've understood that from some of the concerns that we've heard from Meta, from Snap, and other companies in the digital ad space. So that earnings miss wasn't terribly surprising. But the outsized decline in revenues from YouTube, which is one of its principal generators of ad revenues, was absolutely notable. And for me, JD, the narrative change now is what's interesting. Google seems to be taking a page out of the Meta platform's playbook, and they're now going to be focusing on cost cuts, on pulling back of investments into divisions that aren't generating profits, at least not expected to in the near term, and just becoming much more disciplined with respect to capital expenditures and all the rest of it. And that's very much echoing what Mark Zuckerberg told us earlier this week. Meta was rewarded for it. Google has yet to be so, I think, because its cost base is so elevated. Investors really want to see in great detail how they're actually going to pare that down over the coming months in order to compensate for the ad sales headwind. So to some degree, I think investors are in a show me mood right now with Google taking the stock down as a result.
Show me. What have you done for me lately? The show me state, Missouri. I don't know if you've ever been to Missouri. That's my favorite state nickname, the show me state. That's not important to the topic at hand. It's just reminding me of that. It's Friday. We can have some fun. Why not? We're making up the rules as we go. The points don't matter. The numbers do, however, especially for Apple. That company witnessing the largest revenue decline seen since 2016. What else do we learn from that company's report? My goodness, we were following this one very closely. What happened?
We were indeed. The stock had turned green the last I looked. It will probably stay positive for the rest of the day. And I think it speaks to a couple of different things. Firstly, Apple's transparency. They were pretty straightforward with us back in the latter part of November when they warned about the supply chain disruptions in China, the impact they were going to have on iPhone sales over the holiday quarter. And that's precisely what happened. We saw an 8% decline in iPhone sales. They came in light of forecasts at just under $66 billion. The assumption being, JD, that sales were not necessarily lost over the December quarter. They're just delayed into the March quarter because demand hasn't really changed. Not everyone agrees with that thesis. We're seeing forecasts from Samsung, for instance, which says the global smartphone market is going to contract. Taiwan Semiconductor, which is the biggest contract chip maker in the world, says pretty much the same thing. But Apple's demand has remained consistent, and investors are more than happy to believe Tim Cook's projections because, of course, that he's earned the benefit of the doubt through the entirety of his stewardship of the company. So the fact that Apple said iPhone revenues are going to accelerate into the March quarter seemed to placate investors with respect to the earnings miss, and it's turned positive as a result. Underlying that, JD, there was another number that really jumped out for me, and that was the services revenue component. Services revenues were up 6.4%, just under $21 billion US dollars. Now, services, of course, is sort of Apple TV, Apple Music, Apple Pay, and all the rest of it. I was just doing some back of the envelope numbering, and services revenue for Apple, if you strip it out and just have it as a standalone, on a quarter-per-quarter basis, it outpaces McDonald's, Starbucks, Taco Bell, and Chipotle combined. That is the kind of revenue that this portion of the business, which is still reasonably small compared to Apple's overall sales, powers, and how significant it actually is. Apple mentioned, JD, that its installed base, the number of actual pieces of hardware in pockets, on risks, and on desks, is now at 2 billion. That's an absolutely staggering total. And if people are within that ecosystem, they're going to spend more in the services component. So seeing that growth and seeing the significant growth rate seems to be as well a sort of placating factor for those who saw the iPhone sales miss and understand exactly why it happened.
This may be the beginning of a third phase in recent market history with regards to the tech stocks. A brutal 2022, a huge overperformance here to kick off the year in January. And I think people are sitting there right now, as of 10:55 on this Friday morning, looking at earnings, Meta aside, these other names specifically, and saying, uh-oh, oops, did we get a little too far over our skis? What happens next year for the tech names?
I really think it's going to be about maturity, value, and growth. In other words, the growth tech stocks are going to struggle. The companies that are promising earnings, but much further down the line, are not going to find favor from investors in the way that they have in the past. Again, that's going to be largely because interest rates are going to be higher, but also because investors are simply not willing to extend that kind of risk profile in a way that they used to. That will bring investors into companies that they feel has more market share maturity and indeed leadership that is able to keep a control on costs while continuing to generate cash flow. Meta is a perfect example. The stock is down today, but it isn't really down that significantly when you consider it had its best gain in more than a decade only yesterday. So if investors are holding in, they are beginning to believe the messaging that's coming from senior leadership there and the change in direction, or at least focus on cost cuts over growth at any price. If Google is able to replicate that, they're going to get rewarded as well. Apple, of course, is just a titan of its industry, a brand of an impeccable nature, and it's being led by a man that has absolute trust and confidence from the markets as a result. So I really think that's the sort of the big picture narrative shift this year, JD, is going to be the bifurcation between stocks that simply haven't delivered and investors are running out of patience, to those that are growing in markets that are mature, consistent, well understood, and led by men and women who know what they're doing.
Real quick here, Martin, before we head to rapid fire, earnings next week, what are you following?
Actually, for the most part, I think it's going to be a bit of a slow one until we get into the retail space. So the markets are certainly now going to be more digesting kind of what they're seeing on the economic front and what they have walked through this week in order to find direction. So I think it's going to be more of a broad-based economic week as opposed to one focused on earnings.
Yeah, absolutely, and we'll continue to track those numbers. I was looking to see when do we expect these retail figures? The following week?
Yes, I think it's generally.
Oh, Macy's is the 20, as late as the 28th. Yeah, so we still have a little while to go, at least for some of the retail
they wrap up
numbers, and that's
at
great.
the end of January. Yeah.
Right, of course, especially given the expected holiday surge, but we'll see what those numbers look like. Yeah, great, Martin, that's an awesome preview. That we're going to have so much to talk about. I'm looking forward to it. Okay, now on to our rapid fire section for the morning here, my friends. First up, Martin, how did Nordstrom's value increase by $1 billion? Billion with a B?
By $1 billion, by one billionaire. Ryan Cohen is the activist investor, a Canadian by birth, who's been involved in a lot of meme stock names over the past couple of years, Bed Bath & Beyond, GameStop, to name but a few. Reports suggest he's taken an activist stake in the struggling retailer. He's going to push for changes on the board level. And I think a lot of retail and meme stock investors assume that he can work a similar magic to the gains that he was able to net out from Bed Bath & Beyond. He got into the stock in March of last year. He got out in August. He made $60 million. If he's able to execute something like that, investors think they might be able to trail alongside for some gains. So the stock soared as a result of that. I don't know that he'll be able to execute major changes. The Nordstrom family still owns about 25 to 30% of the whole of the retailer, but his name associated with it is clearly something that the markets like.
You're not kidding. All right, number two, what is giving Tesla a big boost in China?
Yeah, the price cuts that we've talked so much about, JD, certainly seem to be paying off. We had a big jump in China sales for Tesla. That's, of course, its most important market. Just over 65,000 units were sold over the month of January. That's up 18% from December and 10% from last year. And this is all even within not only the disruption that we had in the Shanghai factory, but the fact that it's the Lunar New Year. Told us in the investor call after the fourth quarter earnings that January bookings were at the fastest pace. Seems to be proven correct. Really big demand. Price moves, price cuts seem to be lifting that as well.
All right, third and final. What is behind the big earnings miss for Starbucks?
China, again, JD, is the biggest component of that miss as a result of the COVID crisis that really only wrapped itself up in the final weeks of last year. There was a big decline in same-store sales for China. They were down about 29%. That was more than 4 times what the company had forecast, and it pulled international sales down as well. And that was offset a little bit here in North America. Comparable sales were actually up 10%. I believe that's probably as a result of people heading back to the office, commuting patterns getting a little bit more normalized, and people buying breakfast and getting maybe a drink on their way home. Revenues were a tiny bit light at $8.7 billion, and earnings missed as well. But Starbucks was a little bit sort of indecisive, if you will, as to when they're going to see the turnaround that they're hoping for in the China market. And as a result, investors are taking down the stock pretty sharply today.
Are you a Starbucks fan? And if so, really my question is, are you a fan of Starbucks cake pops?
Ooh,
specifically.
I am not that decadent. I tend to split my coffee budget equally. If I'm buying a hot beverage, it's almost always Starbucks. If it's cold or iced, it's almost always Dunkin's.
Whoa, wow, I like that. Okay, good. I'm a big
Yeah.
Dunkin'. I'm always Team Dunkin', born and
Yeah.
raised in North Jersey. Don't mess with our Dunkin'. But those Starbucks cake pops, though, I asked with specificity, Martin, because my goodness, are they good. And I used to eat far too many cranberry bliss bars, which is this like holiday, talk about decadent. It's like cloyingly sweet, but it's this little thing they used to make during the holiday season. And otherwise, I'm not a big Starbucks guy myself. But listen, Martin, I'm a journalist who asks the hard questions, like, do you like Starbucks cake pops? You know me, right? You got to get yourself a journalist who could do it both. Ask tough questions to members of Congress, and also ask Martin if he likes cake pops. Martin, thanks for helping us get smarter today on all of this and so much more.
You have to speak the truth to power, JD. I can fully appreciate it.
That is what I'm here to do, and if the people no longer are in favor of Starbucks cake pops, I'm in the position to hold the company to account. The great Martin Baccardax, thank you as always. Enjoy your weekend. We'll do it again soon, Martin. Thanks.
Thanks, JD.
All right, folks, that's going to do it for The Street today. Stick with The Street for more on these and all of the major market stories that matter to you, and we will see you next week.